and welcome to AIC News. I'm Libby Potter. In today's programme, we're going to be looking at how investment companies work, asking about the benefits and risks, and explaining how you can buy them. Well, the Association of Investment Companies represents hundreds of companies managing billions of pounds, including some of the biggest companies listed on the London Stock Exchange. And most importantly, they can deliver better long-term performance for you. So what are investment companies, sometimes better known as investment trusts, and how do they work? Our reporter has been finding out more.
An investment company is a fund which pools money from investors and then invests this across a wide range of different investments in order to spread the risk. They have professional fund managers who look after this portfolio and aim to maximise your returns.
We've got investment companies in a wide range of different sectors. So, for example, if you're a younger person looking to build up capital for your retirement, there are plenty of funds that are in our sectors which concentrate on growth. Obviously, if you're a little bit later in life trying to generate an income for investments, then investment companies have got an incredibly positive story to tell, with companies that have been able to maintain and increase their dividends quite literally for decades.
Investment companies are owned by and run for their shareholders. They have an independent board of directors to look after your interests.
Quite a powerful feature of investment trust companies. It means there is somebody there looking after your interests, which if you're a relatively small retail investor, I think can give you a lot of confidence.
The boards do control the investment managers. The investment managers are accountable.
They also look at performance and monitor performance and can make changes if that's not going well.
The presence of an independent board is one of the reasons why investment companies can have lower charges than other comparable funds.
At the front of most investors' minds is the question of risk. Well, investment companies differ in terms of the range of risk. Most of them invest in assets such as shares, which are relatively high-risk investments which can fall as well as rise in value. So investment companies should be held for the long term. But as a potential investor, it's a good idea to take a closer look at how these investments work to understand the benefits and the risks. Investment companies, unlike other funds, can use something known as gearing. Gearing means borrowing money to buy more assets in the hope that the returns on those investments will be greater than the costs of borrowing. Used well, gearing can boost capital growth or dividends for you. But gearing comes at a risk. If the investment company's portfolio falls in value, it can increase losses. However, you should remember that investment companies tend not to use high levels of gearing, and in fact many use no gearing at all. Another key word is discounts. Shares in investment companies are bought and sold through the stock market, so the price that you can deal at may not be the same as the value of the underlying assets of the investment company. The difference between the two is known as a discount or a premium. Now, if the share price is below the value of the underlying assets, the shares are said to be standing at a discount. If the share price is above the asset value, it's said to be standing at a premium. So depending on when you buy or sell, you may end up getting a price that's better or worse than you might expect. Equally, investment companies offer some key advantages. They can invest in a far wider range of investments than other funds. This includes high-growth private companies, property or infrastructure projects. These kinds of investments can be more risky, but they also have the potential to perform well in the long term. Investment companies also have a special advantage when it comes to providing a reliable income. Investment companies, unlike other similar funds, can keep back some of their income each year. When times are tough, they can use these reserves to maintain or boost dividends. Some companies have used this advantage to increase their dividends each year for over 20 years or more. So, put simply, investment companies can offer better performance over the long term, but you may find the journey bumpier along the way. You need to make sure that you're happy with the amount of risk you're taking, stick with it for the long term, and make sure you can sell when you want to. If you do decide to go ahead, there are a number of ways you can buy shares in investment companies. Our reporter explains how.
There are three main ways to buy investment companies: through a stockbroker, through a fund manager scheme, or through financial advisors.
You can either go to the stockbroker direct, or you can look at one of their online share dealing services, which tend to be cost effective. The fund manager route gives you the option to put shares into things like a share save scheme or into an ISA or junior ISA, and the benefit is you can buy small amounts every month, so you can drip feed that money in.
People need to do their homework, they need to read newspapers, they need to search the web. The Association of Investment Companies has a very good website which I think is very investor friendly and gets people, or gives people, the power to learn more.
But if you aren't happy about taking these decisions for yourself, you should take advice from a financial advisor who is able to recommend investment companies. They should be able to help you choose which investment companies are suitable for you and help you invest to them.
Of course, there's a role to play for investment advisors in this space, and I think for people with a lot of money to invest on a long-term basis, then I think it's important that they speak to people like that. Not purely to listen, but I think they should engage with these advisors and ask them, you know, if a portfolio is being constructed for them, why haven't you recommended investment trusts, or are you going to recommend investment trusts?
If you want to find out more about investment companies or how to buy them, you can visit our website at www.theaic.co.uk. That's all from AIC News. Thank you for watching.